Hey guys, so today I have decided to start up another video series, and this one is covering the personal financial planning course. I am covering more of the Canadian edition of this course, so I'm working off the fifth Canadian edition by Chris Robinson. I've provided a link in the video description for you to check out the textbook. And although some of the more of the regulatory topics that will be covered in this textbook are focused on the Canadian environment, a lot of the financial principles and the more of the mathematics and the algebra side of the course is applicable across North America and across any financial planning decision. So it might be helpful for a lot of people. And so I'll be starting off this course merging chapter 1, it's pretty short, with chapter 2, which is probably one of the most important chapters in the entire course. It talks a lot about the interest rate mathematics and how to get the future and present values of annuities and different investment options. And other than that, as always, please like and subscribe to my channel for more videos, and let's get started. So as an introduction, you can think of the financial planning process as a series of decisions on how much money you need at some future time in order to meet your goals and how you will get that money. To reach your goal, you have two sources of money: the money you have now, what's in your bank account, and its invested returns, and the money you save and its invested returns. Okay? And so we can really kind of display this a little bit more mathematically. So the financial goal at time n, if it's 20 or 30 periods in the future, whether that financial goal is $1 million or $10 million, we get to that financial goal by looking at our existing savings, plus the investment income on this existing savings for n periods, plus earnings minus consumption, which equals savings, plus the invested income on those annual savings. Okay, so we're still looking at those two sources: money we have now and the money we save, and the relevant investment income that we earn on both of those sources of money. Okay, and so financial planners can be categorized into four groups. One is salaried employees of institutions, which is probably the most common and what a lot of people think of when they think of financial planners. They work for the big banks, and they are those advisors. There's also commission planners, fee-based planners, and fee-only or fee-for-service planners. And so let's actually talk about these planners and see what are some of the trade-offs that exist between each of these categories. So for salaried employees of institutions, as I said, this is probably what a lot of people know. They provide free advice, often consists of a computer printout. So whether you're going to your local branch and you're talking about opening a different investment account, whether it's an RRSP or a TFSA, or whether you're new to the country and you're looking to get some financial planning services, this is probably right at the door. They're going to sit there and they're going to give you some very boilerplate advice, which is helpful if you don't understand anything, but it really doesn't tailor you to specific needs. And so advice is focused on cross-selling investment products, so it's limited value, and you need to be really a high net worth client to receive special treatment. So you really need to be someone who rolls up in a Lamborghini or a Bentley in order for that branch manager to be like, hey, you know what, I think I should treat this person a little bit more with respect because we could get their service. Okay, so the second category is commission planners. So compensation comes through what they sell. And one of the biggest questions when you're thinking about each of these categories is the incentives of each one. Are you focusing, some of these groups focused and earn a lot of their income based on commissions, based on the amount of things that they sell versus fees, right? And so if you are working with a commission planner, it's in their incentive. In order to put food on their table, they need to sell you more products. And that might not be the best alternative or option for you. And so these commission planners may be employed by institutions or may be independent. Now, fee-based planners, the compensation comes through a mixture of fees and commission. So it's much better. The incentives are much more aligned rather than just simply commission planners. But you still have a few questions when it comes to their incentives, and they're almost always independent. So they're the types of people who either are close to retirement in their industry and they've decided to work from home and kind of have their own little book, or they're very young in the industry and they're just trying to get their feet wet and really understand, and so they've taken on a few people and they're just working with those people. They don't work with any standardized institutions. Now the fourth category, fee only or fee for service planners, they charge their client on an hourly basis, and although they are a more expensive alternative, incentives align with clients. And in the book, the authors Chris Robinson and Kwok Ho, they suggest that this fourth category, fee-only financial planners, is the best alternative, because in the end, although it might cost you more, you might have to sit for a few hours and really talk over your expenses. At the end of the day, they're focusing on, okay, let's actually talk about what will help you, not what will pay my salary, right? So that's really important. Now, the Financial Planning Standards Council, the FPSC, sets the path to certification in Canada. And so there's the Certified Financial Planners course, the certification, the CFP certification. And so this is the path to achieve that certification. So first you complete your FPSC core curriculum courses in university at the college level. You then pass your first exam. You then complete 1 year of practical experience as you study for the capstone course. You then take the second exam, and after 3 years of combined experience, you then get your CFP designation. And this is probably nowadays it's really expected to work in the industry. So it's something that a lot of people, if you're going into this industry, you should really focus on getting. Now, that's essentially chapter 1. It was really short. I do recommend that if you want to go in depth and hear the author's perspectives on the industry and on financial planning, then you buy the book. And as I said, you can check out the video, the link in the video description. But in chapter 2, now we talk about the time value of money and interest rate mathematics. So the fundamental principle in finance is that $1 today is worth more than $1 tomorrow. Based on this assumption, when factoring for time, we need to discount future dollars to the present in order to compare investments. So if you've taken any previous financial course, this will probably be something quite easy that you'll understand quite easily. But if you haven't, then this is really important. In the end, $1 today, I can do with whatever I want with it. And in the end, that provides a lot more opportunity than if I were to receive $1 tomorrow and I had to wait one period to receive that dollar. Right? So that's why I value $1 today more than $1 tomorrow. Now, the discount rate, which we'll refer to as K in a lot of our formulas, is the interest rate or rate of return that we use to equate amounts of money paid and received in different periods. We also say that this is the opportunity cost of money. It is what you earn if you don't spend the money today. So it is the opportunity cost, the alternative that exists when considering investment decisions. In order to compare alternative investments, we must keep everything equal. That means risk, income taxes, and the time length of the investment must be identical. And one of the important considerations is the discount rate, the rate of return that we consider on investments, because a lot of the times different financial products will report different rates of returns. And so we cover essentially the biggest ones and the most common ones. There's the arithmetic rate of return, the geometric rate of return. I've actually made a separate video on this on my channel already. So if you really want to look into this, then you can check that video out. But those are the two common ones. Then, of course, there's the annual percentage rate, the APR rate, and the effective annual rate. Now, the arithmetic average is probably what, when you think of average, it's probably the average that you think of. In the end, if you were to add up X amount of numbers and divide by the number of numbers, that is the average. And if you say that's the average, that's the arithmetic average. So that's quite easy to understand. The geometric average, another name for it, is the compound annual growth rate. You've probably seen it in investment courses, or if you're reading financial reports, they say the compound annual growth rate because it accounts for that compounding effect of rates of return. And so in the end, what you do is you take your rate of return, so your R1, you add 1 to it, you add 1 to each of the rates of returns in each of those periods, and then you multiply each of those net results together, raise it to the power of 1 over n, the number of periods, minus 1, and that is your compound annual growth rate. Okay? Those are quite easy to understand. So let's actually look at an example. So to better understand the two averages, consider an example. So if there is a security with a 5-year return of 10% in the first year, then a 8% decline and 4% decline in years 2 and 3, then a 40% return in year 4 and a 12% return in year 5, the arithmetic average is essentially adding up all of these returns and dividing by 5, the number of periods, to get an average arithmetic rate of return of 10%. Now, the geometric average, we add 1 to each of these rates of return in each of these periods, then multiply the results by each other. So we add 1 to 10% to get 1.1, then add 1 to negative 8% to get 0.92, etc., etc. Then we multiply the results by each other and raise it to the power of 1 over n, 1 over 5 in this case, and minus 1 to get a geometric average of 8.78%. And there's also some common rules. The geometric average at most can equal the arithmetic average and is most likely less because it accounts for that compounding effect. Okay. Now, the annual percentage rate, the APR, is a conventional method of quoting interest rates that ignores the compounding effect. The periodic rate is multiplied by the number of periods in a year. So say, for example, you have a monthly interest rate of 1%. The APR is 1 times 12, the number of months in a year, to get an annual percentage rate, in this case of 12%. Now, that's extremely simple to understand, but it fails to account for the compounding effect. In the end, that 1% a month later needs to account for the 1% of the 1% that already existed, right? So there's a compounding effect. And so instead of using the APR, we can use the effective annual rate, the EAR, which accounts for this compounding effect. And so the formula is you add 1 plus the periodic rate. So say, for example, it's a monthly interest rate of 1.25%. So this is our example. Then we do 1.25%. That is the monthly rate raised to the power of 12 minus 1 to get an effective annual rate of 16.08%. And actually, I'll probably do some more examples later on. But say, for example, you receive a question where it quotes the annual rate. First, what you do is you divide by the number of periods that it is compounded by. So if it's a monthly rate reported as an APR of 12%, then you divide by 12 to get the monthly rate, and then you raise it by 12 to get the effective annual rate. Okay, so that's really important. And this is the formula is relatively easy to understand, but we'll do some questions later on. Now we can introduce the future and present value formulas. Again, if you've taken a finance course before, this is relatively easy to understand. It's not that complicated, but for those who haven't, it's something that we need to go over. So for the future value, to get the future value of anything, you take the present value, multiply it by 1 plus k to get the next future value. So what is the future value of $100 invested at a rate of 4%? Well, next year, that $100 will be $104. And the present value, on the other hand, you discount it, so you divide by 1 plus k to bring it back to the future. So what is the present value of $104 with a 4% interest rate? Well, now we take that 104 and we divide it by 1 plus k, 1.04, to get $100. That is the present value 1 period back. Now, of course, we can account for time. So we can extend our previous equation to get the future value of an amount invested for any period of time we want, denoted by n. So now the only difference between these two is now we add we raise it to the power of n. Both this 1 plus k, we raise it to the power of n to account for that factor of time. So the future value interest factor, the FVIF, is present value times 1 plus k, the same thing we've already done, raised to the power of n. And so that accounts for the compounding that exists regardless of the number of periods, whether it's 2 years or 10 years, right? And for the present value factor, value interest factor, the PVIF, you divide the future value by 1 plus k raised to the power of n, okay? And n is the number of periods. Now, this is probably where a lot of people get lost. These are a little bit more tedious equations to do, and thankfully enough we have financial calculators, but I will ignore the financial calculators in this video. We will do everything by hand. We'll use our calculators to solve it step by step, just so you understand the the concepts themselves. So let's talk about an annuity. An annuity is a payment that is the same amount for many consecutive periods. Many pensions are paid as annuities. The rent for an apartment is an annuity. So say, for example, your monthly rent is $1,000. That is a rent that happens on on a periodic basis, on a monthly basis, and it is consecutive. In the end, it will be $1,000 for X amount of years or whatever, assuming that the rent does not grow. So when does the payment transaction occur? So if it occurs at the end of the month, as a lot of rents do, it is a deferred annuity. If it occurs at the beginning of the month, if your landlord is not that trustworthy and they want the monthly rent at the start of the month, then it is a annuity due. And so the payment is made at the start of the month. So a deferred annuity is made at the end of the month. A annuity due is made at the start of the month. Okay, so now let's look at these formulas. So if you want to calculate the future value of an annuity, you can use the future value interest factor for an annuity, the FVIFA, which is indicated here. Okay, and so essentially we take that future value. So we take the future value, this present value times 1 plus kn. But now we take that 1 plus k raised to the power of n minus 1 and then divide by k. And so then our annuity payment, in this case, we replace the present value with the periodic payment. And then we multiply that annuity payment by the net result that comes from this to get the future value of that annuity X amount of years dependent upon the k variable. Okay? So let's look at an example. So you send your son $100 every Christmas for 10 years. He deposits it into a bank account earning 6%. That is our K number. How much does he have after the 10th gift? Okay, so Christmas happens at the end of the year. So what happens is that 1 year later he receives another. So it happens at the end of the year. So it's a deferred annuity, and we input the variables into the formula. So this is the same formula. Our K in this example is 6%. We're not accounting for any taxes as of yet. Our N is 10, and then our annuity is 100. And so we do 1 plus 0.06, so 1.06 raised to the power of 10 minus 1, all divided by 0.06 times 100 to get a future value interest factor annuity of after 10 years of $1,318.08. So if your son receives $100 every Christmas for 10 years, and he invests those $100 into a bank account earning 6%, after 10 years, his net earnings, his net savings will be $1,318.08. Okay, so now let's look at the opposite. Let's look at the present value. So to calculate the net present value of an annuity paying out for n years, you can use the present value interest factor for an annuity, so the PVIFA formula, which kind of flips things around. So in the previous example, you saw that our 1 plus k raised to the power of n minus 1. So our 1 plus k is on the left-hand side. Now it's on the right-hand side. And so we're now actually subtracting it out of 1. So it's 1 minus 1 divided by 1 plus k raised to the power of n, all divided by k times the annuity payment. Okay, so this is quite tedious, I understand, and again, the financial calculator speeds the process up. You don't really have to remember the formulas, but if you are being tested and you can't use a financial calculator, then you need to understand these formulas. And there are, again, practice makes perfect. You just do a lot more questions, you practice those examples, and you'll kind of begin to remember these equations. Okay, and so as always, let's look at the original, so the present value formula, which states that we're dividing the future value by 1 plus k raised to the power of n. So now we strip the future value and we put that out here, so we're multiplying it by the future value. But in this case, we're dividing 1 plus k raised to the power of n. So we're replacing this future value with 1, and then we're subtracting it all out of 1 and dividing that by k. Okay, again, looks tedious. I get it. I remember the first time I was learning this, I was really frustrated. But again, practice makes perfect. Okay, So say, for example, your son asks for the next 5 Christmas presents. So we're building off the previous example. So he receives $100 every Christmas. So say, for example, he asks for the next 5 Christmas presents in advance. How much should you give him? So what is the present value factor of those 5 annuity payments, those 5 $100 payments right now, right? And so we use this formula. So the annuity payment would be $100. The interest rate remains the same, so it's 6%. And now there's 5 periods. And so we work through this formula to get a present value of an interest factor annuity of $421.24. And so if you remember, again, like we are in the future, he's receiving $500 across 5 years. But in the present, as we are applying the basic financial theory that $1 today is worth more than $1 tomorrow, then if he's receiving dollars tomorrow, he's receiving less dollars today. And this is why this $421.24 is less than the $500 that he is expected to receive in the future. Okay? So in contrast to an annuity where the periodic payments are the same, a constant growth annuity, a CGA, is a stream of payments that grows at a constant rate. So similar to the future value interest factor annuity and the present value interest factor annuity formulas, you are able to calculate the future value and present value of a constant growth annuity. And so an example of a constant growth annuity is, say, for example, your landlord states that your $1,000 rent will increase at a rate of 1% forever. Okay, then you know you know the growth rate and you know the initial annuity. Okay, and now we can use those formulas to calculate the future and present value depending upon the number of periods and the interest rate. So to get the future value, you use the future value of constant growth annuity, the FVCGA, to calculate. So we take our X is our annuity payment, the initial one. Then we multiply it by 1 plus K raised to the power of N minus 1 plus G raised to the power of N, all divided by K minus G. Okay? So say, for example, Dale, who's 30 years old, plans to invest 10% of his income every year until he retires at the age of 65. His current income is $50,000, and it is expected that this will increase at 5% a year. Contributions are made at the end of the year. Okay? So in this case, he makes $50,000. 10% of $50,000 is $5,000. He plans to invest this amount, these $5,000, for 35 years. So we put that into our formula. The discount rate or the interest rate is 10%, and the growth rate, the G percentage, is 5%. And so we put that in. So here would be 10%, and here would be 5%. We raise it to the power of 35 and the number of periods, and we get a future value in this example of $2,258,642. So if Dale were to invest $5,000, that an initial $5,000, which is expected to grow at a 5% rate for the next 35 years, in the future, after 35 years, he will have $2,258,642. Okay, so now the opposite is the present value. So to calculate the present value, you use the present value of a constant growth annuity, the PVCGA, and the formula is as follows. So X is our initial starting annuity payment. Then we multiply that by 1 minus 1 plus G divided by 1 plus K raised to the power of N, all divided by K minus G. Oh my God, that formula looks really confusing. I know. Believe me, I know. But I've been practicing and I've been doing a lot of these examples when I was doing the course as well. And so I really kind of drilled it into my head. Once again, practice makes perfect. Or if your teacher is very nice to you, you'll probably get a crib sheet. And so then you can just write these on your crib sheet and then use them. But it's important to at least understand them. So let's look at an example. So Mr. Smith, he's 65 years old, has just retired. He estimates his annual expenses will be $25,000 and increase at an annual rate of 3%. He does not expect to live past 90. So interest rate is 6%. How much does he need to support his post-retirement expenditures? So we need to calculate the present value, the amount of savings that he needs right now in order to live for the next, for the next 25 years at a annual rate of $25,000 that will increase by 3% every year. So we take those numbers. So 25 years he expects to live. He needs about $25,000 every year. That is the X value, the initial X value. It grows at 3%, the G, and the discount rate, the interest rate is 6%. We input this all into our formula, all these calculations, blah, 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 blah. And at the end, he needs, Mr. Smith, in this example, needs $426,794 for the next 25 years to live at the life he expects to live at. Okay? So let's talk about factors affecting the discount rate, so that K variable. Although the easy alternative is to use the interest rate, estimating the discount rate is very important to account for numerous factors. These can be the risk premium, the risk, income tax, and inflation. And I actually have done a lot of videos for more advanced financial concepts, so valuing companies, valuing stocks, and how do you achieve those discount rates. Because in finance, when you go into finance and investment banking, one of the common discount rates that is used is the weighted average cost of capital, which accounts for the cost of debt and equity, the main sources of capital. And so that discount rate accounts for a lot of these factors that we'll talk about. But we're going to talk about a more simplified version of this. So the pure time premium is a price that we demand for waiting before we consume. So since we let someone else use our money when we invest it, we need some compensation for deferring the pleasure of using it to buy something we can consume. So the pure time premium, the longer you hold on, that discount premium needs to account for that for higher deferred consumption. Okay. Now the interest rate risk of changes in value of bonds as central bank changes overnight lending rates. So the interest rate risk essentially talks about that overnight lending rate that the Bank of Canada or the Federal Reserve has influence over, and it is the risk of that changing, of increased volatility in that, which would change the valuation of bonds and overall the valuation of investments. Okay. Now, one consideration in financial planning is whether to use current dollars or constant dollars. So current dollars would be nominal and constant dollars would be real. So if you've done any economics courses or previous financial courses, this shouldn't be of concern. But if you haven't, essentially what this means is that the money that you have right now, the $20 in your pocket, is nominal dollars. It is current dollars. The constant dollars is what those $20 would be worth 10 years ago or whenever we started our benchmark, dependent upon inflation, right? So the advantage of using current dollars is that we are getting the values that we expect will occur. So the current dollars, we understand it within our current settings, so it's much easier to understand how it applies to current prices. The advantage of using constant dollars, however, is that we can understand and relate to amounts expressed in today's dollars. So that essentially states how has things changed over time? How has the value of different prices or of different goods changed over time? And so we compare it using constant dollars, right? So there's a simple relationship between real and nominal dollars and real and nominal discount rates. The nominal rate is simply the real rate compounded at the rate of inflation. Thus, we have an inflation premium and the nominal discount rate, and it will be higher than the real rate, right? So our 1 plus K, our nominal rate, equals 1 plus K, the real rate, so the constant, times 1 plus I, the inflation rate. So to get our nominal rate, to get our nominal inflation, we need to of course know our real inflation and our real inflation rate and our real interest rate. And so we multiply 1 plus the real interest rate times 1 plus the inflation rate to get 1 plus the nominal rate. And of course, then we can subtract just 1 to get our nominal rate. Okay, so this equation is called the Fisher equation. And so let's actually take a look at an example. So say, for example, you want to buy a car in 3 years that costs $15,000. You have $10,000 in savings, and an investment yields 5% a year, while inflation is 2% a year. How much do you have to save per year in constant dollars? Okay. So first, we calculate the real rate of return. So we take this equation that we already know. So there's a lot of words on this slide. I do apologize, but I wanted to keep it all on one slide. But let's take a look at this. Just want to say that in advance. So let's start off here. We already know this equation. 1 plus K, the nominal interest rate, equals 1 plus K, the real rate, real interest rate, times 1 plus the inflation rate. Okay, so now we can actually isolate and and calculate the real rate of return. And to do that, we'd move this over here. So we divide this side by 1 plus I, and divide this side by 1 plus I. And then we move, and so we'd have this remaining, and then we'd subtract 1 from each side to isolate for the real interest rate, so which is KR right over here. And so to get KR under the Fisher equation, we need to divide 1 plus K, the nominal rate, divided by 1 plus the inflation rate minus 1. And so we input those values, which we already know. So we already know the nominal interest rate and the inflation rate to get our real interest rate, our real interest rate of 2.94%. Now we can calculate savings, invested, and diff. Okay, so so you want to buy a car in 3 years that costs $15,000. You have $10,000 in savings, and how much do you have to save per year in constant dollars, right? So our savings is $10,000. We multiply that by using that future value formula. So 1 plus K raised to the power of N. So 1 plus K real, so the real interest rate, so 2.94%, raised to the power of 3 in 3 years to get a savings of $10,908. So that's what we will have. Now, the difference between that is what we need, which is $4,092, right? And so that's what we need to save in order to buy this car that will cost us $15,000. We then, of course, look at the future value interest factor annuity. We take this number and we input it into the future value, so that's the net result, and we isolate to calculate the payment, the amount of savings needed in order to reach that number, right? So what is the annuity, the annual savings needed? So let's look at our future value. So our future value would be 4,000. We need annual savings. That's what we're looking for. So we input all of these numbers, which we already know, and then we isolate for annual savings in order to calculate that for the next 3 years, we need to save $1,325 to get the future value, the amount of money needed to buy this car of $4,092. Okay? Other than that, that's a quick summary. Let's go over this one more time. I think I rushed it a little bit, so let's start off once again. So, once again, we need $15,000 to buy a car. You have $10,000. We talked about how there are two sources of money. The money that we currently have and the invested earnings on that money, and the money that we can save in the future and the invested earnings on that money. Based on the number one, the current money we have and its invested earnings, at a real rate of return of 2.94%, we will have $10,908 3 years from now when we want to buy the car. The difference between the $15,000 that we need and the $10,908 we have is $4,092. That is the amount of savings that we need, and that's number two. So to get the number two value right over here, we take this number and we need to calculate the monthly saving, the annual savings that we need to put away in order to reach this number 3 years from now. So we take that number, we put it into our formula. That is our result. So it's our future value interest factor annuity. So we put it on the left-hand side of the formula. We then have our K variable, which is the real rate, interest rate, the period, and we isolate for annual savings, the annuity payment. So in annual savings would be $1,325. That is the amount that we need to save in order to buy this car of $15,000. I think that's a better explanation of it. Okay, so quick summary. We talked about the financial planning process, the two sources of money, and the investment income. We talked about the 4 categories of financial planners and their different incentives. We covered interest rate mathematics and the time value of money, the discount rate, the opportunity cost. We talked about the 4 rates of return, the geometric, the arithmetic, the annual percentage rate, and the effective annual rate. We talked about the future value interest factor and the present value interest factor. Then we considered how that's applied in an annuity example, and then a constant growth annuity example. And then finally, we talked about the Fisher equation. So factors affecting discount rate, the time premium, the inflation, risk, and tax. Whew! I was speaking really loudly there and fast. And this is probably what I'm going to do for a lot of my videos. I will provide 5 multiple choice questions, which you can practice, and then I will provide the answers to these questions in the video description. So these 5 questions, the answers to these questions will be in the video description. Try them out first before you check the answers, and then compare your answers to see if you're right. So which of the following cannot be used as a discount rate? And I'll just read off the questions. So number 2, Mr. Smith wants to invest $1,000 for 1 year. Which of the following bank accounts offers the best deal? So this is comparing and using the effective annual rate example. So if the rate of interest increases, which of the following statements is false? Okay? If the nominal rate of interest is positive, theoretically, which of the following cannot be negative? And number 5, you owe your friend some money. You are given the following alternatives of payment. If the current rate of interest is 6% and it is used as a discount rate, which of the following is best for you? And so this is comparing, again, what is the lowest present value in this example? What will be the lowest amount that impacts me in order to pay off my debt the best way? Okay? Other than that, I believe that's it. Yes. So as always, I'm working off the 5th Canadian edition textbook. If you are interested in buying the textbook or learning more about the course, I provided a link in the video description to Amazon where you can buy the book. Also, if you are interested in investing, financial markets, investing in stocks, learning about companies, I do a lot of research for Seeking Alpha. I publish research reports there. So if you want to check out my research, I've provided the link in the video description to my profile. Other than that, as always, please like and subscribe to my channel for more videos. I really enjoyed making this. It's quite long, the first one, but the videos will become shorter as we move through the chapters. And if you have any questions, comments, or concerns, please comment below, and I'll be sure to get back to you as soon as possible. Have a great day, guys.